Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with the weekly review for the week ending August 4th, 2023. Time flies, it's already August, and now let's look at the markets at the close on Thursday. Negative pretty much across the board. We had the downgrade of the US by Fitch this week, which we don't think should cause any worry, but it did have short-term impact in the markets. Markets had been rising pretty much in a straight line for a good few months now, and we were seeing momentum that was pretty strong. So some profit taking, maybe some vulnerability to some negative surprises at play. But the main story here is in the Canadian bond sector here. Higher rates on the year. If there's a downgrade on US debt, that means that you should logically, as an investor, ask for higher rates to hold that debt, so that pushes rates higher, which pushes prices lower. So year to date now we're back into negative territory for the universe in the long end. This is in Canada. We are buyer on weakness of bonds, so we're not worried for the second half of this year. We think this is an opportunity, but still we have to admit that we're expecting better returns as of August for bonds in 2023. Equities lower on the week. Canada underperformed the US, the S&P 500, but the Nasdaq was the worst performer on the week. Price of oil higher, volatility. Russia, Ukraine, the conflict seems to be escalating right now. That pushes the geopolitical risk premium up. 81.55 at the top end of the range. Let's see if it sticks. Maybe there could be some profit taking there over the next few weeks also. Canadian dollar, euro down versus the US and the USD, and gold lower. So a new downgrade in the US, should we worry? We don't think so. It's Fitch that downgraded the US in 2011. Remember that it was S&P that was the largest agency, and no one at that time, it seemed, thought it would be possible to see a downgrade of the US, because that's the largest economy in the world and all of this story. So that created quite a stir. Now, well, some volatility on the week, but I wouldn't say that it changes much. As you can see on the chart on the left, here the interest payments are surging because there's much more debt now. We have this structural deficit that's been in place for multiple years now. When you have the economy with a very low unemployment rate, generally you should have surpluses on the government level, but we still have deficits. In the Trump era, we had deficits. Biden came in still having some deficits, so there's a structural deficit in place that needs to be tackled, because if you just think that nothing is changed and you just look far into the future, well, at some point, it's like the US debt will be taking over their whole budget and taking over the world. Of course, this is not going to happen. At some point, they will be doing something. I always like to quote Winston Churchill, who said that you can always count on the US to do the right thing, but after they've tried everything else. So they're very pragmatic. Yes, we do have a deterioration of the political landscape, the use of the prospect of a default for political purposes and all of that. But the US can always raise taxes. They can always cut spending, can do lots of things before the default on their debt. So we shouldn't really worry. But it doesn't mean that it's not important for the markets, because we've had such good performance recently that at some point, something that might not be as important as it seems could be the thing that creates volatility and profit taking in the market. So let's see where that leads us, but we wouldn't be worried about this downgrade here. Now, maybe talking about monetary policy, which acts with long and variable lags. Well, this morning we had a jobs report in the US and in Canada. Less jobs created in the US than last month, but still a healthy pace. In Canada, negative job creation, so jobs lost, but wage growth reaccelerated again. So it's normal that we don't see the full impact of monetary policy yet, because it takes a while. The labor market is a well-known lagging indicator. So it's the jumbo hikes of summer 2022 and beyond that are the things that will be at play over the next few quarters, few months. even if the Fed or the Bank of Canada decide to hike more now, it's not going to be having an impact on the labor market now. And just to illustrate how the lags are important, here it's the senior loan officer opinion survey on bank lending practices. So it's the lending standards. So on the left you have the lines. If they go up, that means that banks are less willing to lend money to businesses, to households. So you see that it's getting even more strict, except for one line on the lighter shade on the left chart. It's the auto loans that it seems to be getting a bit easier to get a loan right now. But if you take that and you look on the other side and you just inverted the axis to make the point, but there's the lending standards are a leading indicator of bank loans, and credit is the lifeblood of the economy. You need credit to buy big name item, big ticket items, houses, cars. When businesses they invest, they don't just use money that's lying somewhere in a bank account. They use credit to do the investment. So there's a delay here between the lending standards and the bank loans. So on the right, we just inverted the axis of the lending standards is the gray line. As you can see, it leads by 12 months the activity in bank loans. So if you have bank loans that are contracting at some point, and this is what it's pointing towards for 2024, then that means that the credit cycle stalls, go into contraction, and this becomes a very strong headwind for the business cycle. So if you look forward in 2024, we should see the impact of all of this tightening of monetary policy being at play. So yes, the economy is resilient now. Yes, even though the Fed and the Bank of Canada are thinking about pausing or ending, maybe being at the end of the cycle, and you see, well, the economy still holding together. Well, it's just because it's delayed. It should be in 2024. Remember, in 2006, at the end of the summer, we had an end of the hiking cycle by the Fed. Everything looked well then. Then 2007 slowed down. In 2008, that was something else. We don't expect it 2008, but there was a delay. And the same thing in the summer of 2000 when the Fed stopped hiking. The recession came in 2001. So same thing here. We're not of the school that this time is different. So question is, are investors complacent? It depends on who you ask. So on the left here, you have the AAI bull-bear spread. So it's a survey of retail investors. Now we're seeing lots of bulls compared to the bears. And typically, if you look at the relationship in the past, you've seen this as being a peak, and then after that sentiment turned the other way. Will it be the case this time? We don't know. It's human nature. If you look on the right, it's a composite index from Bank of America. It's still middle of the road. They're not too worried. There's a lot of stuff there. One of the most bullish indicator that they find is the fact that the cost of protection now is one of the lowest in history. So that means that no one wants to buy protection through options to hedge their bets, meaning that that's a sign of complacence. And sometimes in the past, that was a useful tool to call for a contrarian trade. When everyone's just thinking that something will happen, often something else happens. So there's a lot for everyone. We don't know in the short run. It's very hard to call, but still there are some asset classes where we do see reasons to be very careful. And here we'll end on that. It's the high yield corporate spreads. So the high yield bond, the lower quality of corporate bonds. The spreads are really diverging from the fundamentals. So on the left here, you have the bank lending standards again. When they're getting tighter and tighter and tighter, you should see wider and wider spread on high yield, meaning lower and lower prices. And now you see prices that are going up. So gravity here could be at play, at work over the next few months. Same thing on the right with the business cycle. So the ISM manufacturing index tends to follow the spreads. Now the spreads are going in a different direction, and our leading indicators for the ISM manufacturing index are pointing towards even lower values. So here, diverging from fundamentals. So it's the bet that we have in our funds, and we've had for more than a year now, underweight high yield because the fundamentals are not favorable, and we're keeping that position. So what to watch next week in Canada? We'll have building permits, international merchandise trade. In the US, the NFIB Small Business Optimism Index, but the most important indicator will be CPI inflation. Month over month should be sideways, 0.2% month over month. So in the right zone, I would say. But year over year, starting to go up again because the headwinds from gasoline prices continue to dissipate here. So where to find us? ia.ca/economy for the podcast, for these reviews. Social media, we don't say Twitter anymore, we say X. So we're on X and on LinkedIn. And on the right, iagam.ca, so IA Global Asset Management. We have our webpage, /insights. Macro and strategy, this is our monthly. There's the keys to the market, which is a weekly too. So lots of material there for everyone to appreciate. So thank you for following us on a weekly basis. Always a pleasure to serve you. And I'll be back again next week.